So, you get stock from your company. That's fantastic news. But what if I told you there could be a hidden tax trap just waiting for you, one that could cost you a fortune? Let's dive into this, because getting a handle on one simple concept can literally be the difference between a huge tax bill and a huge win. Oh, absolutely. The answer is a huge yes. We're talking about a difference of just a couple of days. Literally, 1 or 2 days in when you decide to sell your shares. And that tiny difference can completely change how much of that hard-earned money you actually get to keep. But here's the good news. This isn't some unsolvable mystery. The rules might seem a little weird, but they're clear once you see them laid out. So, in this explainer, we're going to break down exactly how this all works so you can walk away feeling confident and ready to make some smart moves. Really, it all boils down to knowing the rules of the game. And the number one rule you need to master is all about time. Specifically, it's about how long you hold on to your stock before you sell it. That's the whole shebang right there. All right, here's the big, scary-sounding term you need to know. Disqualifying disposition. I know, it sounds super technical, but all it really means is that you sold your stock too early. You didn't wait long enough, and because of that, you've been, well, disqualified from getting the best tax deal possible. Now, you'll see these rules pop up most often with two of the most common types of employee stock plans out there: incentive stock options, or ISOs for short, and employee stock purchase plans, which you'll hear called ESPPs. So, what does too early actually mean? Well, think of it like this. The IRS starts two different stopwatches, and you have to be both of them. The first clock says you have to hold the stock for more than 1 year after the date you actually buy it. That's your exercise or purchase date. But there's a second clock. You also have to wait more than 2 years from the day the company first offered you the stock. That's the grant date. The key takeaway here is you have to satisfy both of these. Not one or the other, both. Only then does your sale become what's called a qualifying disposition. Okay, theory's great, but let's see how this actually works with some real numbers. You're about to see just how razor-thin the line between qualifying and disqualifying can be, and how massive the financial difference is. Check this out. This is a great example with an ISO. The first thing you should notice is that almost everything is identical. Same grant date, same number of shares, same prices. Even the total profit is exactly the same, 35 grand. But just look at that sale date. In the disqualifying example, the sale happened on May 31st, 2023. That's just 1 day before hitting that 2-year mark from the grant date. One single day, and it changes everything. And it's the exact same story with an ESPP. Total profit is $41,500 in both cases. Now, the person in the disqualifying column was smart. They held their shares for over a year after they bought them, so they met that first rule. But they sold before hitting that 2-year milestone from the enrollment date. And boom, just like that, they're disqualified. Okay, so you get disqualified. Big deal, right? What does it actually mean for your bank account? Well, this is where it gets really important. This isn't just a little penalty. It fundamentally changes how the government looks at and taxes your profit. Here's the absolute heart of the matter. When you have a qualifying sale, your profit gets taxed at the lower long-term capital gains rate. But if you have a disqualifying sale, the IRS steps in and says, whoa, hold on. A big chunk of that profit wasn't an investment gain. It was basically compensation, just like your salary. And they tax it as ordinary income. And why does that matter so much? Well, because long-term capital gains get this special preferential tax rate. For most high earners, it maxes out at just 20%. You can think of that as your reward for being patient. On the flip side, ordinary income, the stuff that's taxed like your salary, can be taxed at a much, much higher rate. We're talking up to 37% at the federal level. The gap between those two numbers is huge, and that gap is the price you pay for selling too early. So let's put it all together using the numbers from our ISO example. If you waited and got the qualifying sale, your tax bill would be about $7,000. But if you sold just a couple of days too early, that same exact profit now generates a tax bill of $10,400. Same profit, wildly different ending for you. I mean, just let that sink in. By just waiting 2 more days to cross that finish line, this person would have kept an extra $3,400 in their pocket. That's not a small amount of money. That is the very real power of knowing these rules. So, how do you make sure that you're the one saving that money, not the one losing it? Let's talk strategy. We can build a simple, effective action plan that you can use for your own company stock right now. Okay, Here's your playbook. First strategy. You've got to know your dates, get them in your calendar, and understand the trade-off. Sometimes you might need the cash and have to sell early, and that's okay, but just go into it knowing what the tax hit is going to be. And remember, don't let the tax tail wag the dog. Your bigger financial picture always comes first. Then there's execution. And this one is a huge pro tip. You have to make sure you adjust your cost basis on your tax forms. Your broker's statement is probably going to be wrong, and if you don't catch it, you could end up paying tax twice on the same money. No joke. And finally, if this feels like a lot, that's because it is. Get some help. And hey, don't just take my word for it. The financial firm Moss Adams puts it perfectly. Having a professional help you plan this stuff out is incredibly valuable. A good tax advisor can look at your specific numbers and help you steer clear of all these expensive mistakes. So there you have it. The rules of the game are now in your hands. You can see how just a little bit of planning and maybe a little bit of patience can make a massive difference to your financial bottom line. The only question left is, what's your game plan going to be?